This is our Forex blog for June 3rd, 2013, and there's literally dozens, if not hundreds of ways to trade with our software, but I like to go over what I think is the easiest way, most profitable way, highest probability winning percentage way, and probably one of the only, other than maybe fib targets, the vast majority of the time, tool that actually predicts what the price will do in the future. So let me scroll back and we'll go through these. This is our currency indexes, which shows you what the dollar's doing, what the euro's doing. And basically what we do is we compare all the dollar pairs, all the yen pairs to every other one and create a chart of that pair. And we show you a vast degree of information on the chart. What is the previous day's high in green, previous day's low in red, the point of control, in other words, Friday's, in this case, Friday's most actively traded price. It's going to be a major area of support. Once broken, it's going to act as resistance. So, some days it comes down, stalls here, then you get a bounce. When it breaks through there, that trend's very likely to go down. And that's what I mean by very high probability. You also can see, and just like a regular chart, you have patterns, double tops, double bottoms. This Australian came up to the previous day's high, failed, came up to it again, found resistance. When it broke through there, that's a trend that's likely to continue up. And of course, it's likely to go up to the next fib target. Notice where it stalled and then where it stalled. And the Australian index does not really exist. I create this chart myself. And this is, if you've watched my classes over the years, I've always said I believed in fibs. This is a Fibonacci on a currency index that really doesn't exist anywhere. Maybe some of the hedge funds and institutions and the biggest traders in the world that trade billions of dollars have something similar, but the vast majority of traders don't, and I would suspect that the majority of hedge funds don't even use something like this. So, but fibs still act as resistance. This is a great place to get out of a profit target and look for a counter trend trade. You can look at how long it took before it broke through that second fib target there. You can draw trend lines, trend channels. Trend channels are a great way of, when you see a nice trend like this, and you draw the channel on here, you project it from the high, and then you basically want to buy in the lower quadrant right here. So, unfortunately, in this case, it'll only give you one buying opportunity here at 11 to 11:30. This is a strong trend, and it also lets you know approximate place to get out of your trend trade. If you saw the longer term trend, which is up in this case, the daily and weekly trend is up, and if it was down, this would be a pretty high probability place to sell. And it was in this case too. It still came down a little bit. You probably would have made money against a currency that was going up during that time. But nonetheless, let's just take a look at this. I'm basically trying to show predictive ways of knowing what's likely to happen in the future. Does it happen 100% of the time? No. But anything that happens 60 to 90% of the time, you can profit on, because when you're wrong, you lose 6 to 10 pips. So when you're right, you're going to make more than that. And the bad trades are 3 to 8 pips, and good trades are 10 to 100 plus pips. You never know what the trade's going to do, but if you're in a trade in a currency like this that's exploding up, if you trade it versus one that's exploding down, normally you're going to make 20 to 50 pips. That's from my own experience in trading this the last 2 months. So at 11:30, which currency was likely to go down? This one had already gone down considerable distance, but when it broke down underneath its hourly right here is a pretty decent place. This currency had been trending down for an hour and a half, but it wasn't down that much. The euro is pretty much going sideways, but it's in a downtrend. And the dollar also is extremely weak. So basically, at 11:30 right here, you could buy the Australian dollar and also sell the euro Australian. So let's take a look at those two pairs. These are both pairs that are likely to give you 20 to 50 pips. Australian dollar 11:30, or yeah, I guess well, that's when the Australian pulled back. Let me just take a look again here, find the exact time. It's 11:15 actually, when it hits the lower quadrant. So 11:15, we're looking for buys. Okay, so this one's up above the upper containment band. So myself personally, once it gets 10 to 15 pips above here, I almost never buy. But you can see it did go from 97.50 or so up to 90. It went up 40 more pips. Let's take a look at the Euro Australian, 11.15. Now this is a much better trade because it is not underneath the lower containment band. And 11.15, you have a nice little pullback right here. This is basically the kind of trade I look for. Trends down, and one of the other probability things that enhances this trade is the perfect oscillator shows extreme highs and extreme lows. Typically at the 80 level and the plus 80 level, the market reverses or at least goes sideways. I also have Bollinger Bands around the perfect oscillator and the moving average here in the middle. So anytime the perfect oscillator goes outside the band, as you can see right here, it's very likely to go down, especially since the trend is clearly, without a doubt, down. So when you see this thing go above here, you can even go down to a range chart or a tick chart or a faster chart, 1, 2, or 3 minute chart, and wait for it to break the previous bar's low and you go short. You know, you wouldn't necessarily go short right here. You probably would, and let's do that for example's sake right here. You would probably use something that's faster and therefore allows you to get into trade earlier, so you risk less. The whole key is risking as little as possible and making as much as possible. You know, greed is not good because it tends to make people do bad things, but minimizing risk is always good. And typically minimizing risk allows you to trade more lots, and typically when you do that and you're right, you make a heck of a lot more money with systems that are based on, you know, very high degree of accuracy combined with, you know, 4 to 8 pip losses when wrong. You really can trade a lot of lots when you have super tiny losses like that. So you could, for instance, go down to 3 pips per bar range chart. Let's bring this up on layer 12 so we can see it. This is going to bring up a chart that is made up of each bar is 3 pips. So that 11 o'clock pullback right there, or let's find it exactly, the 11:15 or so pullback. Yeah, 11:15 is right up here. And as you can see, a lot clearer entry. You might, if you're watching this chart, say, okay, I'm going to go short when it breaks this little low here. Or if you really want to, a lot of times they go your way, then they come back again. The second time through, you might go short with your stop right above the high. And so this is what you're risking right here, from here to here. That's it. That's your, you know, it's less than 10 pips on a currency that's probably pretty volatile. So when it comes down 8 to 9 pips, if you want to get out of part of your trade, and a lot of times they do pull back a little bit afterwards before they continue down. And you can certainly scalp these too. You make 4 or 5 pips, you go short again right here. You can kind of just run a trailing stop right above, you know, those bars high. And obviously once it starts to explode down, you know, you're out of the second trade. If you decide to get out with a small profit in the first one, you're out of the second trade, and maybe you're short around 25. It's working its way down. Here it looks like it's a double bottom. Let's just say you get out at 3,400. You're never going to catch every pip. Let's just say you get out at 3,405. You're short at 25. You just made 20 pips on that trade. And that's a very realistic amount for that trade. And if you don't like range charts, you can use tick charts like 50 tick. Now you can see 50 ticks per bar instead of actual movement. And so looking at the tick chart, when it came up back up this area right here, you might have gone short, put your stop above here. You can see it came down, went up, came down, couldn't break this low. You know, you might have got out of that trade here at 27, you're in here at 32. After the spread, you probably didn't make much. You can always draw trend lines on pullbacks. This high was not able to take out this high, so you're short again. You put your stop above the high here. Oops, sorry. Put your stop above the high here, and when it comes down, it's going sideways. You move your stop above, you know, that swing high. It makes a new low and comes up. You move your stop here. Comes down and moves up, you move your stop here. Sorry, I keep hitting the wrong thing. Now once it moves a decent amount, which can be anywhere from 10 to 15 pips, you can draw your fibs on that. And then you have your fib targets, which, you know, the second one, the 1.618, is very likely to be the max low. In this case, it never made it down to that level. Actually, it came very close to 1.382, about 2 or 3 pips away from it. And you can see another hash mark right here. There's some fib levels that some people have asked me to put in there. I don't want to clutter up the chart with the actual numbers, but I put in hash marks to show them. I don't remember the exact numbers because I don't really use them that much myself, except for maybe profit targets. I think 23.7 or something, and 76 something. And then I have a fib target down here, which is a little bit before the 1.382 level. And so if the currency is kind of extended, a lot of times that hash mark right here is a pretty decent place to kind of get out of your trade. So you can see that price is right here at 91. You would have been short at 25 for a nice almost 35 pip move using range charts. And again, let's just show one more way of using these tools for predictive purposes. Obviously, a support area like the previous day's low in the euro, the point of control, the price most actively traded on Friday. I don't do these for Sunday because it's not a full trading day. Once it breaks the previous day's low and the point of control, people who are long from Friday and are holding longer term positions, once it goes below that level, you know that most people that have long positions on Friday are losing money. Stops are going to get hit, causing it to go down. So at 7:30, which currency is the strongest? Well, the pound's over its previous day's high. The Australian also is, and it also busted through last week's most actively traded price. A major resistance area. Hit resistance here the first time and second time. So selling the Euro Aussie at a little bit before 8 also makes a lot of sense. We already have this one up here. And again, as you can see, a little bit before 8, the currencies, or I think it was around 8, a little bit after 8 actually. Here's the previous low. You got a little bit of a pullback. Notice it hit the upper area right here. You look for a short. I mean, just an absolutely beautiful move that fell pretty much from 75 all the way, fell 100 pips. And what a phenomenal and predictive type of trade that is. Let's look for some other ones. And a lot of people like to trade euros type of currency. So you can also look for volatility patterns like wedges. And basically all this is when volatility goes from being high to smaller, and keeps getting smaller. When it breaks out of there, it's very high probability. So which currency was strong? Well, the dollar wasn't. The yen, the daily and weekly trend was up, and the majority of the movement was to the upside. It's also underneath its lower Bollinger Band on the index. If it can go back above the hourly moving average here in gray, that could be a really good one. The pound is also a very high probability one because it's also above its previous day's high. This one's at resistance right now, so until it breaks through there, I wouldn't take that one. So let's take a look at 620 selling the euro pound. This is a very high probability trade that I would label maybe 70 to 80% probability. And that is at 6:15, I guess. And what's also nice about this is the pound was very strong. As you can see, it trended up. It also is pulling back, and it's right at support. And I bet if you drew your fibs on the pound, it's right at the 62% retracement and the hourly. So, keep forgetting the time there. Okay, a little bit after 6. Oops. Alright, so a little bit after 6, you can see that we had a pullback on here. If you missed that trade, nice little kind of flag pattern or wedge pattern, beautiful breakdown. And you have your fib target from this as profit target to shoot for. I tend to short here, get out, wait for a pullback, get short, draw the fibs again, and you can see that right here. Let me show you. Fibs from the previous move. Notice how the dotted line fib target was where the market hit. It's also right at our lower containment bands at the time, and the market exploded down and then kind of went sideways and just kind of drifted down. You can see our perfect oscillator is actually going up. That's never a good sign for the trend to go down. Typically I don't look for counter trend trades at the lower white band. I typically will get into counter trend trades underneath the white band. I did so in the euro dollar today and had an amazing counter trend bounce. I can show that chart at the end. But once you're out of that trade, and you look for the pullback, notice it made a 50% pullback. Perfect oscillator had just tagged the upper Bollinger Band right around here. So you're kind of looking for a sell right here, and you have your first and second fib targets. And you short, and this thing just goes pretty much right all the way down. I would have probably exited half my trade here when it stalled, and then the other half, typically 90% of the time if I'm still in the trade, when it hits a 1.618, I'm out. And this is kind of where I start to look to scale in, somewhere between the first and second fib target. I'll use very fast tick charts to do that. I'll just show the euro dollar trade today. I think I got in pretty light right here, and I started scaling in progressively heavier, but my average price was pretty much right here. Within 10 minutes it started shooting up. I was doing something else, and I have a script that exits my trades for me, and it scales out when certain profit thresholds are met. But you know, I looked over there and I was up a lot of money. I thought, wow, what the hell? And I looked at the chart and it exploded. Typically it doesn't explode up so fast outside the bands, but when the bands get hit, typically you do get big moves. And like I said before, if you draw your fibs on previous swings and they happen to line up with fib targets, and it's outside the bands, you know, if you started looking to get progressively heavier and heavier into shorts, pulls back, you make money. You start scaling in again, pulls back. You know, a lot of times counter trend trades, I'm very quick to get out if it doesn't go my way quickly. You know, the second trade right here, when it comes down and goes sideways, I'd get out of half, put my stop above here, and typically draw a fib target on this and get out whenever it hits a fib target, which I'll show into end class. Fib targets usually a place to get out. Two wave pullbacks.